S&P ESG Global Macro Index, a dynamic, diverse, multi-asset approach to ESG. Environmental, social, and governance investing, better known as ESG, continues to gain traction in global markets as investors are increasingly using ESG factors to identify material risks and potential growth opportunities. As ESG data has improved, new indices have emerged, offering broader access to sharper ESG tools. We designed the S&P ESG Global Macro Index to deliver stable returns irrespective of market conditions through a geographically diverse, rules-based, dynamic mix of fixed income and ESG equities. The equity component consists of three of our headline ESG indices: the S&P 500 ESG Index, the S&P Europe 350 ESG Index, and the S&P Japan 500 ESG Index, providing geographic diversification and the upside potential that comes from equity exposure. These indices include the top 75% of market cap for the parent index, ranked by S&P DJI ESG scores, which are based on over 2 decades of the most financially material and relevant ESG signals within each industry. We designed our headline ESG indices to generate returns in line with the underlying benchmark, helping market participants align investment objectives with their ESG values. The S&P Global Macro ESG Index's fixed income components consist of 3 futures indices: the S&P 10-year U.S. Treasury Note Futures Index, S&P Europe Bund Futures Index, and S&P 10-year JGB Futures Index provide stability and additional geographic diversification. So how does the index adjust allocations to adapt to different market conditions? First, it uses leading market indicator, the OECD Total Composite, to determine the current macroeconomic outlook. Calculated on a monthly basis, the OECD Total CLI has extensive geographical coverage and moves in the same direction as the business cycle. Typically, the CLI can provide 6 to 9 months advance notice of anticipated market turning points before they happen. Then, the index uses regional equity market momentum to determine the current market trend. Next, the index allocates between fixed income and ESG equity assets based on the market scenario determined by steps 1 and 2. During expected upward cycles, the index dynamically adjusts allocations from fixed income to equities to enhance its upside potential. When market signals indicate a potential downward shift, the index moves back to safer fixed income to protect against loss. Finally, the S&P ESG Global Macro Index applies a daily risk control overlay, adjusting allocations to maintain its target volatility below 5%. How has the index performed? The effectiveness of the S&P ESG Global Macro Index's dynamic asset allocation is evident over the past decade. The rules-based strategy's ability to adapt to market phases provided higher returns, lower volatility, a higher Sharpe ratio, and lower maximum drawdown compared to a static 60/40 equity bond allocation with a 5% risk control overlay over the same period. To learn more about our range of S&P ESG Global Macro Indices, including indices adding commodities to the asset mix and currency-hedged versions, visit www.spdji.com.